A very good evening, everyone, and thank you once again for joining us on this Financial Literacy Thursday. It is always a pleasure to be here in this safe space where we come and learn together. So tonight, I want to begin with a question, just a simple question. How many of us went to school, worked so hard, built careers, and learned how to earn money, but we are never taught what to do with that money once we earned it? That is actually the purpose for tonight. So we learned many important subjects, but most of us were never formally taught how to build wealth, how to build, to protect that wealth or that income, and how to prepare for our future and our family's future retirement. So we can spend years preparing for a career, yet very little time preparing for our financial future. So at the end of it all, we work so hard, we prepare so hard, but are we making sure that what we're doing today, it is going to be transferable, it is going to be generational? So the topic for tonight, as you saw it, it is essential financial life lessons schools never taught us. We learn so many things. We learn about geography, a history of the US, of everywhere, but it doesn't hit home to make sure that we are really learning what is essential for us, for our families, for our finances. And the biggest cost of waiting on learning is time. Money can sometimes be replaced, but time can never be replaced, because the longer we wait to learn, the longer we wait to start actually planning for our future, that time will never be replaced. So tonight we'll focus on those major, there are so many pillars, there are so many essential pillars that we can think about, we can learn about in regards to our financial futures or lives. But today we picked only three: how wealth grows, how insurance works, and why retirement planning should start with our first paycheck. So those are three. Those are not the only ones, but those are the ones we picked today to make sure that we look at those and see why we are never taught about it, although they are considered to be essential. So we're going to go ahead and get started. I will show a few slides. And then after that, of course, I'll learn from you as well, as always. That is how we do it here. We come here and learn as a community, learn from one another. Everyone has something, one or two to share, and that is why we always consider that important. So again, our topic is essential financial life lessons school never taught us: how wealth grows, how insurance works, why retirement planning starts with your first paycheck. If you're to get somewhere, if you're to get to that financial freedom that we all are looking for, but again, it starts with you, with me, and right now. Oh, so my name is Immaculate Businje. I'm a financial professional. This is my passion. This is my crusade to make sure that we all, as a community, as a people, as families, we learn. We learn about our financial matters, those money matters, financial education. It is key to everyone. Just in case you ever want to contact me, those are my contacts right there. But as for now, let us focus on those three essential financial lessons that were never taught in schools, although we paid so much money to get educated. Again, tonight, the roadmap is right there. How wealth grows, as they can show us on number one here. Income is the starting point of everything, but wealth is what you build, what you're able to keep, grow, and own. So we're going to look at the difference between the income, the paycheck, the money we bring in, and the wealth. And here they're showing us income is wealth is what you build, not what you make, and what you're able to keep. So how insurance works. When we talk about insurance, insurance is very broad. I happen to be actually fortunate to work in this kind of a space where we offer different kinds of insurance. We have the life insurance, we have the health insurance, car insurance, home insurance, business insurance. But do we understand? Are we taught in schools how insurance works. The only thing they always actually tell you when you turn 16 and you get a car is to get your car insurance. If you get a home, is to get your home insurance. Nobody's going to tell you that your family, yourself, your business needs to be protected, because that is not whose business, that is your business. And that is why we are here as a community, to learn how those insurances work. It's not one, there are many. So, and why retirement starts early. So here, the earlier money gets time to work, the less pressure falls on your future self. So when you start retirement, the meaning of actually saying that why retirement should start with your first paycheck is because the earlier you start, the easier it is going to be for you not to be burdened, not to be pressured, because you're counting 5 years, 10 years, 20 years to retirement. If you start at 25, you have a long way to go. So it's going to be easier for you. So we're going to be looking on those 3 pillars: how to grow our money, how to ensure that, and how to make sure that our future is as well protected. So looking on that part 1, how wealth grows, we'll actually go there and look at, so earning money is not the same as building wealth. We saw that. What is income? Income is what you earn, your salary, your commission, your business income, your wages. That is the income. Something you bring in every 2 weeks or every month. That is the income. And what is your wealth? Your wealth is what you're able to keep, what you're able to grow and own. What is that? Your savings, your investments, your equity, your businesses, the businesses that are able to actually make more money for you, make more investment for you, and assets. You have homes, you have other investments. That is your wealth. Not the money you bring in, but because if you make a lot of money and you're not able to keep it, you're not going to say you have wealth, because that is what comes in and goes out. We are going to look at some real life examples to see the difference between actually whether you making more money, does it make you wealthy? What makes you wealthy? Is it how much you make, or how well you're able to protect what you earn? So here we are seeing that a higher income can create opportunity. We all want to make more money. We all want to make sure that we are on that space whereby we make good money. But our habits and decisions determine how much of that opportunity becomes a lasting wealth. Imagine that you're making so much money, but what are your habits? How are you spending your money? Are you saving something? Are you spending everything? So we're going to look at that in the real life example here. So we're looking at this gentleman here who happens to earn 120,000 a year, but he happens to live paycheck to paycheck. You wonder why? Because of his high spending habits. He has a lot of debts. He has no emergency fund, meaning that if something was to happen, because he spends everything that he earns, he's not going to be able to make it even 1 month or 2. He has little or not even no savings. He's earning higher income, but low wealth. Why? Because he's making a lot, but he is not able to keep anything. He's not able to save anything. Versus this young lady who is earning 60,000 a year. He lives below her means. She lives below her means, saves consistently. Remember, the purpose is not saving a lot. The purpose is not investing a lot. The purpose is the consistency. Are you able to save something? She invests regularly. It doesn't matter whether she's investing $100, $50, $200, but that is regular. And she builds assets over time. So they're showing us high income earner, low wealth, a moderate income earner who is able to build some good wealth. So it is about the habits. We're told it's about the habits that decides whether whatever you're earning is going to be productive for you. So what are the results here for these two young people? The results for the higher earner who is not able to save, he's always stressed today, no financial security for tomorrow. The one who is earning a moderate income but is able to save is building wealth, financial freedom for tomorrow, because again, she is saving. Remember our topic, how to grow our money, how to ensure that, and how to retire comfortably by planning starting from today. So income is what you earn. Wealth is what you keep. So don't focus on how much money you're making. Don't focus on waiting until you make 200,000 to be able to open that investment account, that life insurance that gives you protection at the same time gives you savings for the future. Because again, it's about your habits, not about how much you're able to earn. So we are looking at the wealth building flow here. How does that work? A paycheck becomes powerful when it is giving a purpose. Again, that is the flow, how your wealth comes together. Remember, we saw it's not about how much you earn, it's about your habits and how you're able to save what you earn. So here they are showing us you work and earn, you receive your income. If you receive that, are you saving something? Set aside a portion of your income consistently. It's not about a percentage or how much you save, but save consistently. It doesn't matter. But whatever you're putting aside is going to earn up. Then invest the portions that you're able to save. So we do work in the financial industry here. We work with some great products like Index Universal Life Insurance, whereby you put your money, you work with a compounding interest, whereby the money builds over time and you're protected today. If you get a critical illness, a terminal illness, or even death, and in the future, if you live longer, you're able to get your retirement benefits with one payment. So save whatever you're making, save aside, be able to invest. Don't just put it in the bank. Because I always tell people, I met one client who was telling me, but why do I have to invest? Because I can save my money. I'm able to put $1,000 on side, but that 1,000 you're putting in your bank, whether it's you earning, I don't know how much you can earn in your savings account. We all know it's very little. But if something was to happen to you, even if you're saving $1,000 in a year, it's going to be only 12,000. But if I put on side, if I put on an IUL at $300 or $500 a month, and something bad happened to me, I may be able to get $1 million. For you, you're going to get 12,000. So it's not the same. So make sure that what you're earning, you're saving, you're investing, and then to be able to build the asset, creating the wealth that will give you a lasting financial freedom. We can see from making the money, planting the seed by saving, you growing it, and then you're living the dream that you want to live. So again, the point here is consistency. Consistency turns financial intentions into a financial system. It will never be possible for you if you're just earning and you have no consistency in saving or even investing for the future. So we're talking about the compounding growth, the power of compounding interest that we have in one of our products, which is the Index Universal Life Insurance. For example, we can give an example of someone who is paying $500 a month. It depends on this again depends on how old you are or the capabilities of how much you can put. We tell people there is no limit of how much you can put. There is no small money, there's no little money. You put how much you can. We sit with you, we do your needs analysis to see how much you or your family is able to afford to put aside. Remember, The important part is actually doing something and being consistent. So this person was putting $500 a month. Hypothetically, they were earning 7% on average return on annual. So if this person was put that $500 a month, they are showing us in 10 years, this person will earn $87,000. $500, earning 7%, that is on average. In 20 years, they'll earn 260,000. 30 years, 610. 40 years, 1.3. So all this is showing you, if you earn, we saw the person who was earning 120, but they were living paycheck to paycheck. It is about the intention. It is about the discipline. If you took aside, just put aside $500, trust me, you might not even feel it. But if you don't, it's going to be swallowed into something else that you're not even going to see anything. But you'll be surprised how 20 or 30 years goes by without you seeing anything on your bank account. But if something is invested, it is a plant you planted somewhere, and it is going to yield into something big. So let us use the system, leverage the system to help us earn money, plus use the investment portfolios that are protected, that are protecting your money. That is why actually we are here as financial professionals. Don't just put the money where they tell you, hey, we'll earn you more than half. Be diligent. Make sure that the investment portfolios you're using, they are vested. You make sure that they are actually working for you, not against you. So what are the hidden costs of waiting? If we waited so long, saying that I'll start when I earn more money, I'll start when life slows down. Guess what? Life will never slow down. Instead, it keeps on actually going on a higher speed. I'll start after I pay off some stuff. Maybe I have a car note. When I'm done paying my car note, I'll start saving. I'll start investing. But guess what? You never know what will happen tomorrow. If, for example, you're waiting on paying a bill to start on a life insurance, who knows what will happen tomorrow? Do you know when an illness can strike? Do you know when a death can strike in your family? So I'll start next year. You never know, you don't even know if tomorrow will come. So the cost is not only contribution that you miss, it is also potential growth that your contribution no longer has time to earn. Remember, if you're earning compounding interest, someone who started last year is earning more money and you're not earning nothing. If it was to protect yourself or your assets or your business, if you waited a year later, if something was strike, then you're going to be in trouble. So let us be intentional with everything that we do. Let us not wait, because time wasted again will never return. So again, we talked about building wealth. It is so good to earn and save and invest and grow your money. But what good is it if you're building wealth without protecting it? It's like you try to build that beautiful home, but it doesn't have a health like a home insurance. You have a beautiful family. That family is not protected with life insurance. You have a car, a beautiful one, but it's not protected. So they are showing us here what could disrupt everything you are building. You never know. So anything that can happen to you or your assets or your family, you never know. So that is why actually insurance, it is supposed to take away the risk. You transfer the risk from yourself, from your family, from your business to an insurance company. That is why we say we protect ourselves for unknown. So let us look at this example here. You build your wealth for 20 years, 20 years of building. Your savings, you're saving some money, you're investing, you bought a beautiful home, you have a beautiful business, retirement goals are in there. That is the savings you have in there. Everything's shooting up, but look at what could happen. One major risk, your income can be interrupted. You can be hit with a major medical cost if you're not protected, if you do not have a health insurance, if you do not have a life insurance, and your loved one is gone, or you as a main source of income, you're gone. Property loss, you can lose your beautiful home if it's not properly actually insured. There is being insured and there is being underinsured. Is your beautiful home, your actual American dream home, is it properly insured? So don't wait for that loss. Liability, if you own a business and you don't have a business insurance, you can actually be hit by liability costs that you're not insured for. Death happens to the family. Are you protected? So what good is it if you're building anything, but you're not protecting it? So protect what you're actually earning. What you're building deserves to be protected. That is actually when you say that what you're doing is actually going in the right direction. So insurance, what is it? So insurance is a protection strategy. So some people feel like, hey, I'm getting this to, it's not a get rich quick thing. So insurance is not primarily about creating wealth. It helps transfer or manage certain financial risks. So one major event, be a critical illness, be a death in the family, be a terminal illness, be a business exposure to those liabilities. This insurance, in general, what it's going to do, it helps transfer or manage certain financial risks. So one event does not have to absorb everything you have built. You know, we work so hard, we try to build a lot, but let us try to make sure that everything that we build are well protected. So let us look here. So you work hard to build your income, your assets, and your financial future. The same energy you put into that, the same sleepless nights you put in that, make sure that the insurance protects what you've built by making sure that you're managing life's unexpected risks. Because we do not know what will happen tomorrow. And then you continue building, with protection in place, you can move forward with confidence and continue building because you know that you're building on a firmer ground. Your foundation is very strong and nothing is going to shake what you're building. So building empires and making money without having protection is like building your home on a sand. Because if wind comes in, or any tide is going to blow away everything that you're building. So focus on the foundation you're building to make sure that the wind is not going to blow away everything that you have put in so much time, energy to build by protecting everything. So it so happens that when it comes like to life insurance which happens to protect our lives, our families, our assets, we have a big gap in the US. When we look at the statistics here, this was the sources is from LIMRA. If you can actually look it up if you want, we have a big gap. So when we look at millions of American families could face financial hardship if the unexpected happen. We're looking at these big numbers. 74 million Americans need life insurance. They do not have anything. It's not about even if they have a small part, they need. Many households have no life insurance coverage at all. They don't even have anything, not even the group life from work. So when we look at the other percentage, the 25 million Americans need more life insurance. When they talk about needing more, their current coverage may not be enough to protect their family's future, or even they might have like a group life insurance from work, whereby if they lose their job or if they leave their job, they lose it there. So where is the gap? We have to make sure the bottom line is life insurance helps protect what matters most your income, your loved ones, and your future. So how do we close that gap? We have to close the gap with what we are doing here. These crusades we do every Thursday and every single day. We have to make sure that no family, no community is left uneducated, because everything happens. We're going to see that. Why? Why are there those gaps? What happens? Why many Americans, or why people in general, don't own enough life insurance for their lives and for their families? We have some reasons here. Some do own a little bit, others do not own anything at all. So let us look at the percentages here. Again, we have the source. You can go back in there and read for yourself and see how this is a big problem that we all have to make sure that we close this gap. So we are told here that 46%, the reasons people do not own life insurance or only not enough is because 46% say they perceive the cost. They feel like life insurance is very expensive. What is expensive? Your life or what you're paying to protect it? So we can ask ourselves. And 33%, they say they have other financial priorities. So what could be the priorities if you're making your money, your investments, your family is not protected, but you think you have other priorities? So this again is a lack of a financial literacy. That is why we are here all the time, to make sure that we all understand what is important. Is it my life, my family's lives, my assets, what I own, or even anything else that I spend on? Because whatever else we spend on, it can go and pass, but our families has to be protected. And then the 22%, they're not sure how much or what type of life insurance they need. Again, that is why we are here. We are here to close that gap, to make sure that you and your family understand exactly what you need. When it comes to life insurance, there are different kinds of life insurance out there. Don't be fooled by maybe one major kind. Maybe someone will tell you, hey, the index universal life insurance is the best. Yes, it is good. But if you cannot afford it, you can even get a term life insurance with living benefits that you can pay a fraction of possibly $50 or $100 and protect your family until you're able to move to the permanent one. So again, the main important part here is to start with something. Start with what you can afford until you get to what you want. So don't leave their future. That is your family. So life is unexpectable. Life is unpredictable. Life insurance helps protect your loved ones and your financial future. So don't predict the future by saying that I will do next year or 2 years to come when I'm done paying off my mortgage, because this beautiful family here relies on you to make sure that their future and their today and tomorrow is set. Don't leave their future to chance. Be prepared, be protected, and be there when you're needed the most. So we are looking into now, how do we close the gap? Closing the life insurance gap. How can we do it as financial professionals, as a community? Because we know it is very essential. It is very important. So we can look at the simple process here of how we can do it. First of all, understand the need. We help you go through a financial needs analysis. What you as a person or as a family, what do you need? We go through your financial goals, your income protection, your debt and expenses, whatever you need to protect. We do a needs analysis for you to understand exactly what you need, so that you don't live in not knowing, thinking that, oh, this is something expensive that I cannot afford. So determine the right coverage, because everything out there might not be good for you. So what is good for me might not be good for you, or might not be affordable for you or for me. So pick the right coverage for you that is going to work with you and with your family. We help you calculate how much life insurance you need and choose the best option that fits your family. And then you understand what you need, you determine the right coverage and the right amount you can afford, then protect that beautiful family out there. Make sure that your family that depends on you, it is fully protected. So we are here, we're always here every Thursday, 1 hour. Actually, this is a crusade we are on. There is no family, no community is going to be left uneducated. But again, 1 hour is not enough. That is why we tell you, book a session. We have free sessions for you to do a needs analysis for you and your family, so you do understand all this. And if you happen to have one, review it. May you got a policy when you're still young, with no family, with no assets. Now it might be the right time to review what you have and see if you need a change. So don't stay stagnant. Always be in a know of what you do have and your family. And then the last part was supposed to talk about is the retirement. We talked about how we grow our income, how we protect our income or our wealth. Now we're talking about our future, which is where everything goes. Because if we're working so hard today, trying to save, we want to make sure that our future is going to be greener. We don't want to be living a good life now when we're able to hustle, and our future, when we're not able to do anything, we're going to be suffering. So retirement is not only an age issue, it is a time issue. Most of the time we see older people struggling to see if they can save something because they have 10 years to go. So if we make it an age issue, that is where stress comes in, when you don't have enough time to save at your own pace. So, but when we make it a time issue, we learn how to start early. So we are looking at this timeline here. Someone who starts at 25, it is going to be easier for them because time is on their side. Someone who goes into 30, you're planting the seed and you build on those habits of saving. It doesn't matter how much you save, the consistency is what you need. In your 40s, continue, you're consistent in what you're doing. Create moment, you keep on your momentum. On your 50s, your future self benefits because you already see that the benefits actually of your investments and your savings and your life insurance benefits are growing because you started at an early age. And by 60, guess what? You're going to be relaxing on the beach because your future self started early to make sure that your future, when you're older, you're not going to have to worry. So decades of potential contributions and compounding is helped by starting early. When you start early, time is your greatest asset. And then you don't have to worry because you can put in those small contributions that can grow significantly without having to stress, because those small ones are going to compound into more actually wealth. With all that, starting early, stay consistent, and enjoy the future. Everything is about the time, not the age, but focus on the timing that is going to give you the leverage not to stress, but to go by your means. So let us give example, the two people with two timelines. We're looking at someone who started, this young guy who started 25 and someone who started 40. Let us see the difference so that we see where do you want to be? Do you want to start at 25 or at 40? So let us see the difference here. That is, we're talking about the investment, the retirement planning. That is where we are. So starting at 25, this young guy has more years to contribute. So he's not stressed. He can put in however much he can put in because he has more years for potential growth. Even if the market actually crumbles or goes down, he has time to recover. More flexibility to adjust. He can adjust his investments from one portfolio to another because time is on his side, because he was able to start early and got time to work on what he's working on. But let us look at this gentleman who is 40 years of age. He has fewer years to contribute towards his retirement. He has less time for compounding. Remember, the market is not always the same. Today might be on 10%, 12%. Tomorrow it might be in negatives. Although our investments are actually covered on that, we have the flawless that never goes into negatives, but still the market fluctuates. That is why starting early, you have time and flexibility to adjust with how the market is working. So this person may need significantly higher contributions to be able to keep up with his target for retirement. So what is the advantage? The advantage is not only money again. The advantage is the time. When did you start? When are you planning to start? Time is your greatest asset. Use it wisely. So let us not continue to say, hey, I'll do it tomorrow. Because tomorrow again, that is another day that you lose. So how do we again close the retirement gap in our planning? Because it's not a matter of whether you're going to retire. It is a matter of when are you going to retire and whether you're going to be prepared for that retirement. So again, it's not about how much money you make. It's about how well you plan. You plan for your savings again. Plan to start early. The earlier you start, the more time your money has to grow for you. And then save consistently. We're talking about the way we can close that gap. We start early, we save consistently, we invest wisely in portfolios that are going to protect your money. And then remember, the most important part of it all, protect your investments. Make sure your investments, your assets, your family are protected. Manage risks and have a plan that protects your income and your savings, which is the insurance we talked about. We talked about those three pillars. They all work hand in hand. You grow your wealth, you protect it, and then you plan for your future. And then review again. Review regularly. Your life changes. Regular review helps you keep with your plan on track. If you started late, in your 40s, in your 30s, you might want to put more energy or more effort in putting more money if you really want to retire comfortably. Don't actually think that whenever you start, you can start and do it, because you don't even know the expenses you have at the moment. You may have more money today than next year when you want to go and start. So putting everything together, what we talked about now, putting everything together, one connected financial framework of what we talked about. Remember how wealth grows, how insurance works, and retirement planning. So you earn your income and skills. When we are actually investing is not just money. You can invest in yourself, in your knowledge and skills as well. Then the more you earn, you set aside a portion consistently. Again, remember, it's not about how much you put, it's the consistency and the discipline you have in saving. Then invest to grow your money over time. Protect it. Use insurance to protect what you're building. What you're building, that is your assets, that's your money, that's yourself, that is your family. Then grow let your money work harder for you. Leverage the system to help you grow your money and save. Then you create a future income. Build multiple streams of income. Again, we talked about that last week. We have to learn how not to put all our eggs in the same basket. Learn to find different sources of income that will help you live a better life today, but also be able to save for tomorrow. We are here again as financial professionals to hold your hand, to work with you, to show you how you can be able to actually get those multiple streams of income to help you and your family. So we have some questions here in regards to wealth building questions. How do I grow my money? Go back to the same question. How are you growing your money? Think about it, because that's why we are here. When it comes to the insurance questions, how do I protect what I'm building? How do you protect what you're building? How do you protect your family that you have? How do you protect your assets? When it comes to retirement, how will what I build support me later? Do you have a plan in place today? It doesn't matter how old you are today. You may be 15, 20, 25, 30, 40, but do you have a plan in place that is going to help your future or your future or when you go into retirement? So every step is important, but together they build your financial future. So again, that is why we are here every single Thursday on what we call the Financial Literacy and Money Matters Thursday. We are here consistently to learn together, to actually put our thoughts together to see how our financial freedom can be realized. So thank you again so much for listening in, and thank you for tuning in. It is my time now to listen from you. If you have any questions, if you have any support that you want to put in, it is your turn. Go ahead and open your mics. Let me hear from you as well as we get to the end, to the close of this discussion. The floor is yours, Tim. Thank you.
Thank you, Ms. Immaculate, for a great presentation. It looks like the information has been deciphered well and everything has hit home. And possibly mine is just a little addition to what you said. What you talked about was consistency in the investment area, and how the paycheck goes a long way to creating a financial system. So the reverse is also true. Consistency, if you consistently get into debt, what the bank is doing is using the power of compound interest against you, which is ironic. So depending on which part of the coin you are, the power of compound interest does work for us as investors. And if you're a debtor, a borrower, the bank will use that against you. So we are on this side of the coin. We tell you as an investor to keep consistent investment and stay away from debt to avoid the power of compound interest working against you. Thank you. That's my contribution.
Thank you, Mr. Lloyd. I can't say it better. Thank you. This is a good space. This is a safe space for all of us to come here. Always come with any question. And plus, remember, these Financial Literacy Thursdays, we can actually tackle a topic of your choice. We are here for you. This crusade is here to educate everybody, our families, our communities, to make sure that we do understand our money matters. So if you have something on your heart that you want us to cover, let us know. We are here for you, to learn with you. That is actually the crusade we are on, to make sure that there is no topic that is left uncovered. So again, thank you so much for tuning in. This was a wonderful evening again, as always. I'll see you again next week. Look out for the recording. Have a great night, everyone.
Thank you, Immaculate.
Thank you.
Thank you.
Great job.